We have Sushant Bhansali, the CEO of Ambit AMC, on the show now to talk more about markets, and they keep coming out with very interesting research and data-backed notes every now and then. So we'll talk about one area of the market which everybody is calling frothy and very risky now. But is it right to look at the entire small cap, mid cap kind of a basket in the same light? Sushant, very good afternoon. Thank you so much for your time. One section of the market is saying small cap, mid caps are very frothy. They are above their long-term averages in valuation terms. The other side of the argument is that India is a broad-based story. India is about mid-cap, small-cap because they are high growth and their profitability is improving because of digitization and other factors. So painting the entire small cap with the same brush perhaps may not be the idea. Which side of the argument are you leaning on?
Thanks, Ajay, for having me here on your show once again. So I think you rightly picked out that there are two sides. Probably we are on the camp where we say that not everything is frothy. Small caps looking at index level, either the value of the index or the valuations. I would say looking 10 years back and looking now, the NSE 250, if you look at the number of companies and their constituents and their return ratios are very different from what they were 10 years back. There has been huge cash flow improvement, which has led to a lot of deleveraging. There has been less of capex, I would say, in the last few years. That's why all the good cash flows have gone to deleverage themselves. In last 5 years, the deleveraging has happened so much that 1.4 times debt to equity for most of the index as a for each constituents which are there today has come down massively to almost 0.2 times. And these are as good as I would say now net cash companies. So looking at the same index with a valuation multiple for net cash companies versus highly leveraged companies, I would say is not a apple to orange comparison rather. And that's why we believe that this rally shall continue for much longer. There will be hiccups in between. There might be minor corrections, adjustments like any other category and equity markets. But as a category, we believe that the market is going much more broad-based, and historical comparison is not the right comparison to look at this segment.
What among, what else are you really observing for the broader market or the small cap end of the corporate India in terms of operating metrics? Are you witnessing improvement or are there signs of stress in their operating metrics, be it their operational performance or even financial performance?
Yeah, so broadly, as a broad level, I would say large cap, mid cap, small caps all put together, BSE 500 also, if you look at the sales growth has been sort of coming down over the last 2 or 3 quarters. Although this quarter we have seen slight jump in that low single digit sales growth which we are witnessing for last 2 or 3 quarters. So has been a slight jump from that in the results which came for this quarter, and hopefully that shall continue and rise again in the next quarter. On a margin front, definitely because of raw material prices coming down, the inflation cooling down on the WPI side in the last few quarters, margin expansion has been the story and which has led to good profit growth. But this quarter we saw some reversal on that, and probably next few quarters because of the base effect, we will see the margin expansion now rather get reversing. But that should be aided by good sales growth.
When you talk to the managements of some of these companies, Sushant, across sectors, give us some feedback. What are the focus areas? Are some of these smaller guys now looking at big scale-ups? Is there essentially the focus on improving profitability? What exactly the feedback do you gather when you talk with some of these broader market promoters?
Sure. So we've been actually meeting lots of them. We recently came up with another note on the rural recovery as well. And in that context, when we met these owners and management teams of smaller businesses, they all are very charged up. They are very positive in the long-term outlook. And historically, the challenges for smaller companies as to why they didn't make it big, one of the key reasons was high leverage on their books. And whenever macro cycles hit them, they were hit very hard, and it used to take a long period of time for them to come back. They needed at least 2 or 3 good years of economy so that they were back in good shape. But that is not a challenge. I would say equity owners have become, I would say, much more salient. They have become much more reasonable and have been deleveraging a lot and have taken a path to, I would say, consolidation within their own balance sheets, whereby their focus is to grow at a uh, reasonable pace rather than get carried away and do much more higher growth by doing lots of capex using that as a tool. Now, increasing the focus has been to use cash flows to do capex and use that mostly for working capital needs, or where probably you have a large project coming, take a term loan and then don't use working capital alongside for that. So I would say that that has been a big sea change, but they all are very charged up and very excited for the next 5 and 10 years and see a lot of opportunities. Each of them, I would say, believes that as the GDP grows from about $3.5–4 trillion to $5 and $6 trillion in the next few years, the incremental GDP which they have got in the country, given that the population size is smaller or rather remaining stagnant, it has been growing less than 1% for the last few years. And as this GDP per capita increases, there will be incremental spend on discretionary and moving up the value chain, which means that the chappals and slippers will be replaced by shoes. The shoes will be replaced by sneakers. The sneakers will be replaced by luxury. So in each segment, you will have a premiumization play, and there is lots of discretionary spend which will lead to lots of smaller categories actually becoming quite meaningful. So in a summary, I would say people are very charged up and very excited for the next 5–10 years, and they are safely playing it rather than getting overboard and taking huge debt to play on that story.
Excellent. Sushant, anything in particular, any sub themes which you are researching or your team has looked into? Uh, Block deals, selling by promoters, selling by PE players, very large, and retail money, which is actually a representation in the mutual fund industry, is actually buyers. Is this a worrisome sign?
Not really. See, whatever equity market is like another market, demand and supply plays an important role in terms of where the market is leading. And when there is so much supply, which is coming from private equity players, historically it used to be more IPOs. Nowadays it's more blocks, but the demand is very strong alongside. We have so much of money coming not just from bottom of the pyramid, but from HNI, ultra HNI, and globally as well into mid and small cap companies, that there is, I would say, equilibrium between demand and supply at this point of time. I think the private equity players invested a lot between 2005 and 15 in this country, and they didn't find meaningful exits. And now, in the last few years, they've got those exits. And many of the times, there have been trade sales from one private equity player to another private equity player, and those are now getting passed on to the ultimate investors. Now, if you look at the investor basket behind the private equity funds, or whether mutual funds or AIFs or PMSs, ultimate underlying investor base is sort of similar, probably global HNIs versus Indian HNIs, or probably global retail investors versus Indian retail investors. Ultimately, it's the moving from one segment to another segment, and I don't find it unusual or probably something to worry about.
Sushant, let's take a detour from that. And as an industry observer, somebody who's seen big launches by conglomerates, I want to take an opinion from you on Grasim or Birla's foray into the paint industry. We have seen, actually, this announcement came last year. In a very short span of time, they've launched a factory just today at Panipat, and in a 40-minute plus kind of a speech at the launch of Birla Opus, their paint brand, Kumar Birla actually has said that 10,000 crore in top line and a profitable position in the paint business is what they are eyeing within 3 years. People are saying that it could spell a bit of a trouble for Asian Paints and Berger because the space will get ultra competitive. This is after a very long while that we are seeing a large conglomerate foray into a new area of business. What are your thoughts on this? What does it mean from stock market point of view for Asian and Berger?
Yeah, so probably not necessarily speaking on the companies per se, but as a broader theme, I think the disruption which we witnessed in the telecom industry a few years back, right? Or probably innovator industry a while after that. So I think telecom we saw more in 2014, 15, 16 era. Then we saw in the innovator space in 2017, 18, 19. Similar sort of competition play I think is happening in this industry. the incumbents are very strong with a huge market share. It's sort of I would say that a duopoly or probably oligopoly market right now. The top two players have about a 70% market share already. So it's quite intense competition from that perspective, that you have two or three large incumbents with the strong balance sheets and strong distribution and strong brand. But there is, I would say, a space for more players, and the incoming player also probably brings, I would say, deep pockets and a good brand and a distribution network on building material side. So there will be competition for sure. Uh, uh, how the incumbents respond to it will witness in the next few months. So far, the prices of the products, I would say, we don't know how competitive pricing are. They are the new players looking at price as a play to grab market share, or are they looking at more variants or something different and unique to grab market share? But a new player, I would say, not necessarily defeats the incumbents. Many a times, as we have witnessed in many other categories, many times a new player actually expands the industry, which is overall beneficial for the whole industry and the incumbents as well. But definitely, next a few quarters, all investors will have a keen look on the pricing, if there is a pricing war, because that's what happened in telecom. But if you look at the innerwear industry, there was no pricing war per se, but it was more about giving more options and creating, I would say, a larger distribution where only there was one player which was having a large distribution. So there were two different things which we saw in the last 10 years. We, I would say, eagerly wait to see how this industry plays out the new competition.
All right, Sushant, thanks so much for your take and obviously the overall thoughts on the market.